While you were catching up on headlines this weekend, scrolling past another chaotic White House clip, something far more consequential stayed off screen: the silent repricing of power and the quiet rerouting of capital. No sirens, no emergency vote, just signatures, waivers, and markets that refuse to blink. In less than 72 hours, executive authority expanded, institutional resistance thinned, and trillions in U.S. assets sat under a new unspoken assumption that the rules protecting them are now flexible. The stock market stayed calm, bonds barely moved, commentators kept chasing the noise. But beneath that calm, something else shifted, because when checks and balances weaken, risk doesn't disappear. It gets transferred from institutions to households, from public law to private leverage, from your long-term savings to someone else's short-term optionality. This isn't about one president or one party. It's about what happens after markets learn they are no longer the backstop, when executive power can invite CEOs into a room and casually discuss equity stakes, when regulation becomes negotiable and silence becomes consent. And nobody is talking about what it actually means for your wallet. What you're watching isn't chaos. It only looks that way on the surface. Underneath, this is a repeatable economic operating system, refined over decades, deployed whenever power needs to move faster than law. Call it the playbook. 4 stages, always in the same order, always with the same financial beneficiaries. Stage 1, financial isolation. Disconnect the target from institutional oxygen. Freeze assets, threaten access, weaken credibility. In domestic terms, that means sidelining independent agencies, pressuring the Fed, hollowing out enforcement bodies. Capital doesn't flee yet, it waits. Stage 2, narrative control. Flood the zone, not to convince but to exhaust. While the public argues about tone, legality, and personalities, the real story becomes too complex to track. Markets are told this is temporary, strategic, necessary. Stage 3, strategic intervention. This is where power consolidates. Executive orders accelerate. Norms collapse faster than laws can respond. Judicial friction remains, but it's fragmented, slow, and selectively ignored. Uncertainty spikes. Volatility becomes a feature, not a bug. Stage 4, resource extraction. This is the quiet part. Waivers are issued, exceptions granted, meetings held behind closed doors, energy licenses resume, contracts are renegotiated, equity stakes discussed, risk is socialized, upside is privatized. This system doesn't require tanks or coups. It runs on ambiguity, speed, and market patience. And once stage 4 completes, the pattern resets. To understand why this pattern matters, you don't start with speeches or scandals. You start with balance sheets, currency regimes, and resource contracts. Let's rewind to Iraq, early 2000s. Officially, the story was security, compliance, intervention. Financially, the story was simpler and far more threatening. At the time, Iraq controlled the world's second largest proven oil reserves, estimated at over 115 billion barrels. But Saddam Hussein made a quiet, dangerous move. He began selling Iraqi oil in euros, not dollars. That decision didn't just irritate Washington, it challenged the petrodollar system, the mechanism that forces global energy trade to flow through U.S. currency, sustaining demand for dollars, treasuries, and U.S. financial dominance. Stage 1 activated. Iraq was financially isolated, sanctions tightened, assets frozen, access restricted. Stage 2 followed quickly, a narrative built around weapons, instability, urgency. Markets absorbed the story, volatility rose, defense stocks rallied. Then stage 3, strategic intervention. The regime collapsed faster than expected, leadership disappeared from the equation, and here's where most coverage stops. But stage 4 is where the ledger closes within months. Iraqi oil contracts were reassigned. ExxonMobil, Chevron, BP, Shell, and Total gained access to fields once sealed off. Oil sales quietly returned to US dollar settlement, and reconstruction contracts worth Tens of billions flowed to connected firms. Now Libya 2011, a smaller country but a cleaner case study. Libya held Africa's largest oil reserves, roughly 48 billion barrels, and more importantly, 143 tons of gold. Muammar Gaddafi's ambition wasn't territorial, it was monetary. He pushed for a gold-backed African dinar, a currency that could bypass both the dollar and the euro in regional energy trade. For global finance, that was an existential threat. Stage 1 began with sanctions and asset freezes. Libyan sovereign wealth funds, over $70 billion, were immobilized abroad. Stage 2 escalated fast. Humanitarian language, urgency, inevitability. Stage 3 followed. Power fractured. The central authority collapsed. And once again, leadership was removed from the system. Then came the quietest phase. Libya's gold reserves vanished from public accounting. Oil production was reopened under new management. Foreign energy firms re-entered under revised terms. And the gold-backed dinar proposal disappeared entirely. No announcement, no debate, no vote, just a reset of the monetary trajectory. Notice what didn't happen in either case. There was no long-term penalty for investors positioned correctly. Markets recovered, energy profits normalized, capital adapted, because this system doesn't punish instability, it monetizes it. Volatility creates entry points. Institutional collapse creates renegotiation power. Currency threats create justification. This is why history matters, not because it repeats perfectly, but because the financial choreography stays the same. When leadership falls, contracts don't vanish. They change names, and the money never forgets where it's supposed to land. Now bring that pattern forward, strip away the history, and look at the present with colder eyes, because the same operating system doesn't announce itself, it leaves signals. Start with stage 1, not sanctions this time, but institutional pressure. Independent agencies questioned, enforcement credibility weakened, norms labeled optional. When the rules feel temporary, capital pauses, it doesn't panic. Then stage 2, the noise, non-stop headlines, executive conflict, legal ambiguity, the media chases personality, markets are told nothing, structural has changed, volatility becomes background radiation. But watch what happens off camera. Quiet waivers, regulatory exemptions, licensing approvals that contradict the public rhetoric, energy projects halted, then quietly resumed, meetings between executives and policymakers that never make the transcript. Now stage 3, strategic intervention without uniforms, executive orders accelerate, courts respond unevenly, timelines stretch, uncertainty isn't resolved. Its normalized defense stocks drift upward, not on war but on optionality. Energy equities stabilize despite political risk because insiders aren't betting on chaos, they're betting on renegotiation. And that brings us to stage 4, the phase most viewers never see. Capital repositioning ahead of clarity, private equity circling infrastructure, energy majors lobbying for long-duration access, financial firms pricing in a world where enforcement is discretionary. This is where peace is quietly priced, not in press conferences, but in 99-year leases, mineral rights, pipeline access, and regulatory forgiveness. The public debate asks, is this legal? The market asks, who gets the contract? And the market already knows the answer. The playbook doesn't need consensus. It only needs time, silence, and a market willing to wait. And right now, the market isn't nervous. It's positioned. Here's the part that never makes the panel discussion, because the cost of this system doesn't show up as a headline. It shows up as a slow leak in your balance sheet. When executive power concentrates and institutions weaken, inflation becomes policy cover, not because prices must rise, but because volatility allows it. Energy markets price in discretion, not scarcity. Regulation risk gets passed downstream, straight to consumers. That's why fuel prices don't fall when stability returns, why insurance premiums creep upward, why everyday goods reprice temporarily and never come back down. Your 401k doesn't crash, and that's the trick. it stagnates. Index funds hold companies that benefit from regulatory flexibility. Energy and defense weights quietly increase, while purchasing power erodes in the background. They win because they trade around uncertainty. You lose because you live inside it. Private capital thrives in this environment. It buys infrastructure before rules are clarified. It secures long-duration contracts while enforcement is distracted. It profits from spreads created by institutional hesitation. Meanwhile, households absorb the friction, higher borrowing costs, weaker labor leverage, retirement projections that look fine in nominal terms and fail in reality. This is the hidden transfer, not from poor to rich, but from patient savers to agile insiders, from rule followers to rule negotiators. No one announces this cost because no one needs to. The system works precisely because it feels survivable until it isn't. And by the time it's obvious, the contracts are already signed. By now, the pattern should be clear. This isn't about elections or headlines or who's in the Oval Office. It's about an operating system that converts uncertainty into ownership and volatility into leverage. The wealth transfer doesn't happen during collapse. It happens before clarity returns, when rules are blurred, enforcement hesitates, and markets are told to stay calm. You can't vote this system away, and you can't outrun it by ignoring the news, because the real decisions aren't debated in public. They're negotiated quietly, measured in basis points, equity percentages, and contract duration. The pattern creates the wealth transfer. You can't stop it, but you can see it coming. That awareness is the difference between being priced in or being priced out. If you want to understand where capital moves before the headlines catch up, if you want to recognize the signals before volatility hits your savings, then stay ahead of the pattern. Subscribe, because the next stage is already forming, and by the time it's obvious, it will already be too late.